Welcome to the Big Fat Real Estate Checks podcast with Marco Kozlowski, where we help investors like you get the knowledge and skills you need to replace your JOB with passive cash flow for life.
Welcome, everyone, to yet another episode, hopefully a super exciting one, as I typically say, of Big Fat Real Estate Checks, where we go over some really neat ways of using none of your own money to invest in cash flowing real estate, never risking any of your assets or your good name or bad name in buying as many cash flowing and wealth building generation assets for you and your family for a very long time. A little mind block there, but it is what it is. Always live, always interesting. I'm joined today with only Gabriel Araish. Frank is tied up making money somewhere else, doing something else, or with his family, whatever Frank wants and loves to do. And today we're going to discuss perhaps what areas you should invest in and what your investment objectives are, because there's a lot of ways to make money in real estate, and we have just a tiny sliver, which is using asset-based lending, never using your own money. And I was asked recently, well, which areas should I invest in? Because this area is booming, or that area is booming, or this one is showing a lot of, migration, and the population is really increasing here. So I'd like to use funds to be able to buy this property at this price, because I know that in 5 years, or I suspect that in 5 years, or the experts have said that in 5 years, this place is just going to be bananas. And I'd like to explore and have that conversation with Gabriel Araish, my compadre, who is in Montreal. And of course, I am in my cave, my bat cave, if you will, in Orlando, Florida, but of course also originally from Montreal. And we're going to have this discussion. And Gabriel actually listens to the news a lot more than I do. I'm pretty super focused on what I'm doing and rely on the people around me, like Gabe, to, he's really plugged in. So I think it's going to be a really interesting conversation. Again, this is, for us, it's live. We don't really typically plan what we're going to say or how we're going to say it. It goes pretty organic, and we're really excited to have you listen in on our discussion today. And of course, if you have not subscribed yet, please do take the 2 seconds to subscribe, like it, love it, comment. And of course, if you have any friends, family, or folks that you know of that want to build their wealth through the vehicle of real estate and cash flowing real estate specifically, I would absolutely be delighted if you shared this as well. And welcome, Gabriel, to this candid conversation that we're going to be having as to which areas we should be investing in. I'll answer first, if you will, and then We'll go into whatever path that we go into normally. Now, I really don't care where it is, whether it's in Toad-Suck Ferry, Arkansas, Lizard Lick, Pennsylvania, down the street, around the corner, or in the middle of nowhere. As long as the cash flow is there, it checks all the boxes where I can get at least 3 management teams in. So if something goes wrong, I can plug in someone else. It's had a historical consistent cash flow of XYZ, and the asset-based lending, outgo, or the debt service, is a lot less than the money coming in. So if we're getting, for example, a 13% return when we're buying it, and we're only paying 6% for the interest, we make the 7% spread, and 7% per million is $70,000 a million. So if I'm, after taxes, insurance, maintenance, management, and all the other shit that has to be paid, and making $70,000, $60,000, $50,000 per million, I really don't care where it is, because I'm not managing it and I'm just buying the cash flow. I'm basically aggregating what the cash flow is net versus what the debt is costing me. I know I'm buying with an upside, and I'm really forcing the appreciation or increasing rents, reducing expenses, and creating the opportunity that I want in any market at all. And if you buy right, which is the whole point of this, you don't have to use your money, you don't have to use your credit, you use asset-based lenders that need to deploy their cash, and the area really doesn't matter. Now, that's just one way of looking at things, but there are many people. For example, I just had a webinar last week where someone was like, hey, this market is really exploding, and I know it's going to be, amazing. Can you help me out with that? So let's have that discussion outside of the box, if you will, of what we typically do.
Okay. So, and, just to to go back a little bit on what you said, the questions that we get a lot of the time is, what's the best market to buy in? And the answer is always going to be, it depends. And it depends on what you as an investor want out of your investment. So are you investing because you need cash flow right now? Are you investing because you want capital gains because you have a good job or you have a good business, your cash flow is not a problem, you just want to build an asset or park your money somewhere that you consider safe so that in the future you have more of it? Or are you investing perhaps because you need a loss? Some people do that. They need a loss, they need a capital loss, and they find a way to do that. So the answer is always going to be it depends. And just like Marco said, for us, what the avenue we take is we don't like just cash flow, we don't like just appreciation. We're double dippers. We like both. And so when we buy a property, we make sure there's cash flow, but we make sure there's an upside where we can force the appreciation. Because if you rely only on, time will bring the value up, that's like saying, well, I'm going to buy a stock and hope it goes up in the future. And that's not to say that that's wrong. That's just not the way we operate. And as investors, so for me personally, I can speak for myself, where I got into real estate because I wanted to stop working and enjoy life. And to do that, I need cash flow. So the way we do things suits me and my family just right. And I'm going to continue to invest this way, at least for the foreseeable future. Could it be that I have too much money at one point where I just want to buy, this trophy asset somewhere in the middle of downtown, whatever location there is, because I want to be able to tell the world this is my building? Maybe. And some people like to buy trophy assets as well. So the answer is always it depends. And if you want to speculate, that's fine too. Just understand why you're investing in the first place and why are you using real estate as the vehicle in the first place. That's going to be totally dependent on you and your family. But the one thing I will recommend is make sure you have a plan and understand why you're investing before you start looking for an asset.
And not just doing it because you heard it's a good place to be.
Correct.
For example, let's take Austin, Texas, for example. There's a big migration towards Austin. I know a lot of high-tech companies are moving out of California and going into Austin, which is creating, an appreciation because there's a supply and demand, right? So as the market heats up, you want to be obviously at the beginning of that wave versus, the end of that wave. Now, if that's your plan, that's fine. And there are not a lot of great discounts to be had. Remember that asset-based lenders will only lend up to 70% of the value, and that might not be the best strategy if you are a speculator, because I would consider that more speculation than it is investing. It's hoping the market goes up, and obviously you're hedging your bets if there is a big migration into that area. But again, there was a dot-com bust in 2000, and just like any other industry, there's always going to be ups and downs. Or if you're in the oil, in an area where it's heavy oil or heavy dependent on a certain industry, there's always going to be ups and downs, and you have to be prepared for that. So if you're okay with putting 20% down, signing the dotted line, using a bank loan, giving, whatever tax returns, firstborn child, blood sample, whatever other liquid samples that they're looking for in order to qualify for this, the opportunity that you're going to be buying. Could there be a huge upside and gain? Absolutely. But just know the risks that are associated with that, and know that your money is going to be tied up there for as long as you choose to hold the asset. And if it's not cash flowing, that's fine. You just have to be prepared for that. If all the money that you have is in this one asset, do you really want to put all your eggs in that one basket? But if you have more cash than you know what to do with, that might not be a terrible strategy either. There's a lot of ways to invest. There's a lot of vehicles that you can invest in. But again, as Gabe was saying, just make sure that you're doing things with a plan and purpose and with the intention of knowing what your eventual exit could be, or what the long-term plan is for that investment or speculative asset that you're buying.
That's right. And I wanted to add and you just said it, where you have to, in your plan, you have to know what your exit strategy is. Is it just to hold it for, the length of the mortgage and then use the cash flow to just live off of that? That could be a plan. Is it that you want to sell it at a higher value, which is the speculative part? It's just like buying a stock. You buy it, at least what you think is low, and then sell it high to someone else who's willing to buy it at that moment. You need to know that. But if you don't have only one exit in mind, because fortunately, unfortunately, however you want to see it, it's the markets are going to work based on what's going on. Nobody could have predicted I guess some people did predict the 2008 financial crisis, but for the most part, people bought months before the bubble burst, if you will. So, individuals that are in that situation, if they don't have a plan, most likely they had to hand over the keys to the bank. If they did have a plan, or they were well prepared, then they're able to weather that storm with other assets or cash flow from other income streams or whatnot. So it just, this all eggs in one basket is something that I think a lot of us have made that mistake in some way, shape, or form in the past. It's super important, especially in real estate, because real estate is typically, a large investment from a financial perspective, and when it hurts real bad compared to other ones. So, and contrary to, let's say, for stocks, for example, where, if you buy a stock and it tanks, in theory, if you have the kahunas to do it, you can average your price down by buying more and waiting out the wave. You can't do that with real estate. I guess technically you could if you buy other real estate, but you can't buy that same location necessarily, that same street, but you can buy and more assets so that on average you're making a gain. But it's not as liquid, right? So at the end of the day, that's make sure you have a right plan and make sure you have multiple exit strategies.
Well, the difference with stock as well is it's hard to finance stock.
Right.
Right.
You barely can.
Well, no, you can do margins, but if they call your margin, you're screwed.
Correct.
Ask us why we know that. So I don't do a lot of stocks for that reason. But because I can't control a stock price, but I can certainly control what I buy the asset for, and I can see what the upside is and the opportunity is, and see if I can raise rents, reduce expenses, and really have a path and plan to really know exactly what I'm going to be making in the future. So to rope back into, should I be in this area? Well, if you need cash flow, that might not be your best strategy. If you have too much cash on hand and you have absolutely no idea what to do with it, and you're just looking for a place to park it, and there are markets that are hotter than others or really growing more substantially than other markets, maybe that is the right investment vehicle for you to do, if that's what you want to do. Just know that there are risks obviously involved in that. If you're getting into something that's retail today, just know that you're buying something retail with the hope that it goes up. I actually had another call with a gentleman out of Toronto who does pre-construction condos, and a condo downtown in the GTA, the Greater Toronto area, is over $1 million, right? That's for a very small condo, and he does pre-construction. He reserves the condo with a small amount down, and then when they're finished, he either buys it himself or he flips the condo to someone else at a higher price than it was. Now, not a bad play. You got to put the money down, so you need the cash. If you don't have the cash, you have a problem. If you don't close within a certain amount of time, you're going to lose the money that you deposited. So that could be a problem as well. And technically, if they have their agreements right, they can actually sue you for not buying the condo to begin with. So there's that risk as well. However, just because historically the market has always typically gone up fairly well in that market doesn't mean it's always going to do that. And if you're buying $1 million condo and have to put 20% down, that's $200,000 of cash that's invested. After you pay your taxes, your insurance, and you can choose to manage it yourself if that's your goal, but I would rather be shot in the head twice than deal with a Jerry Springer tenant, or be back with both my ex-wives at the same time than deal with a Jerry Springer tenant. Not interested. So I'll pay a management fee. If you take a look at all those fees with the maintenance cost, even though it's a new building, there's always going to be some maintenance cost. You're not going to cash flow at all. In fact, you might still be in a negative cash flow situation, but if the market is going up faster than what you're losing, then you're still ahead, but you have to be able to shell out that cash every single month with hopes that it's going to go up in value significantly. So you're really, again, speculating and you have $200,000 at risk. And is that $200,000 that you put down with that negative cash flow worth your ROI over a long period of time? That's a big question mark. It's very hard to really predict exactly how well you'll do or how poorly you'll do at that point.
That's right. And maybe just to add another portion to the best markets, understand also every state has its own tenant rules, and so understand those. And like, I mean, I'm from Montreal. I mean, over here, tenants practically own the building. Like,
it's easy, right?
Yeah. Oh, yeah. It's so easy.
Easy to get rid of tenant. No problem.
Oh my God. It's. I don't even understand why we're the ones who put up the money as landlords. So it's extremely an excruciating process when it comes to a tenant. Not only a tenant that's a bad tenant not paying, but especially if the tenant understands the rules. And over here, because the rules are so tilted towards the tenants, it's they all of a sudden they all become super interested in the rules and learn them and then use them against the landlords. So for me, going into the US right off the bat was already a huge benefit. But then within each state, some states are more, or have more stringent rules than others. So I know for me personally, that's something I look at, and I would recommend you did too, because you have to know how to operate your building, especially if you choose to manage this yourself. Which again, we don't recommend it. We've been through it. Marco's been through it. I've been through it, and there's a lot of worse things I'd like to do than have to manage a property, but understand how you can get rid of a tenant if they don't pay or if they make a mess, and because that's going to impact your profitability.
Well, like in Montreal, for example, if they're on welfare, you can't kick them out. If it's cold, minus a certain degree, you can't kick them out. If they're pregnant, you can't kick them out. If there's a couple and one has declared bankruptcy, you can't kick them out. And then if the next person so if they declare bankruptcy, then get pregnant after they were released, you can't kick them out. And if you started doing this in the summer and suddenly it's in January, you can't kick them out. And then the other person goes bankrupt, you can't kick them out. So there's, it can be years before you can kick someone out in Quebec. It's very, very difficult.
Correct.
It's a real pain in the ass. Whereas in Oklahoma, for example, you put a notice on the door, and in less than a week later, you got the sheriff with a drawn gun saying, if you're still in this place, we're going to shoot you dead. Tenants know that they're out or they're trespassing, and they, technically, if they create a ruckus, they could be harmed, and they know that they can't get away with it, so they don't stick around. So there's a huge contrast in, Quebec, where it's literally like almost impossible. It's not impossible, but it does take a lot of time. And if you have tenants that are just sitting there, and for example, if you're paying water and you're paying utilities, you still have to keep paying their utilities. You can't shut it off. It's illegal. Mm-hmm. And they're just draining your resources. You still have a mortgage to pay if you've leveraged this, and it can be a real nightmare. And I know a lot of people have been turned off by that, and that is something that you also have to take a look at if you're buying something, even in a hotter market, that if you can't get rid of people, you might be stuck making a mortgage payment and taking care of all these other expenses without getting paid. So you just have to look at the overall pain in the ass factor versus, the risk versus reward, to make sure that this is really the vehicle or the process that you want to use. And there's nothing wrong with writing a check for a property if that's what you want to do. I think it's a terrible use of cash, because leveraging money is much better than using all of it. But you do what the hell you want with your own money. And I know a lot of people that make a ton of money and they're buying real estate cash because they just need a place to park it, because they don't know any better. They don't want to deal with anything else or banks or any of that, garbage. But they're still paying retail, which makes no sense, because if you have cash, you should be at least negotiating a little bit. And that's the disadvantage of going into hotter markets, in that no one wants to sell you anything for anything less than what it is. Right. And, to me, I just can't sleep at night knowing that I paid retail for anything.
And that's what I was saying, that it depends on the type of investor you are, right? So that Marco negotiates his peanut butter at the store. So, no, I'm kidding. Or do you? But ultimately, and on a side note, just to add fuel to the fire, but in Quebec, there's also no security deposit allowed. So because it takes you months to throw someone out, and they know that they're going through this process, they can just wreck your place and then leave, and there's absolutely, you can't do anything about it. So
that's a bitch.
Yeah, it is. So all in all, like I said, it's very difficult to answer the best markets question. It's really depends on you, but things that you need to remember is, why are you investing? What's your objective, short term, medium term, long term? What are your exit strategies when getting into a property? Do you understand the rules? Who's going to manage this? And do you understand the rules around the state that you're investing in? I think that pretty much covers the
and the tax consequences as well.
Fair enough.
Because what you said earlier, we kind of didn't go back to, where some you can buy and have this huge capital gain, which for some is going to be a problem. Although if you don't want to pay any taxes, then don't make any money. I actually heard someone say, well, I'm not going to invest and make $200,000 on a deal because the IRS is going to get some. That doesn't make any sense. If it costs you $60,000 to make $200,000, why would you not do it? That doesn't make any sense. But anyway,
to each their own.
Some people are just dumb as a box of rocks. It is what it is. So you can't fix stupid. That's all I got to say about that. But what you said before, which is, having a capital loss. Now, I just want to touch on that very, very quickly, in that you can actually make money on a property, have cash in your pocket, but on paper, you're losing money. And if you're making a lot of money and have the right investment strategy, you can actually buy the right properties, still make cash flow, but actually have a write-off at the end of the year, which lowers your tax implication. And that is super awesome. And not only do you want to manage all the risks and all the cash that's coming in, because you're always going to have to, partners, which is Murphy. If something can go wrong, it will. And the IRS or whatever tax, whatever tax implication as well in your country. Obviously, we're buying exclusively in the U.S. I buy in the U.S., but if you are, for example, Canadian, you have the CRA to deal with, but there's a way to take care of both and actually minimize your tax consequences. If you do it right in the U.S., it's actually going to save you money up north as well, or down south, or wherever you are in the world. So really a lot of things to look at. And it can get really confusing. Listening to this podcast, I'm like, well, shit, what am I going to do? It really depends. Are you in a position where you have too much cash and you want to, ride appreciation and take that risk? Or are you in a position where you want to supplement your earned income with passive income and never really have to go to any bank ever to, fill out an application to use asset-based lending versus bank, financing? Now, the advantage of bank financing, just to rewind a little bit, is you're not going to pay 6, 7, 8%, 9%. You're going to be paying like 2, 3%. So your cash flow will be higher, or your spread will be higher if you do sign on that dotted line, but you have cash invested, you have personally guaranteed the loan, and if something does go wrong, you will be personally affected. And for me, that's not something I'm willing to do.
Agreed.
Okay, well, hopefully that was sort of kind of clear. And if you want help, if you want us to mentor you and hold your hand and show you based on what your economic situation is, what to do, how to do it, and really plan properly based on what your objectives are, we'd be delighted to help you. Simply send me an email, marco@marcokozlowski.com. That's marco@marcokozlowski.com, and I'd be delighted to help you in any way that I can. Well, that's it for now. Hopefully you enjoyed this very much. Thank you, Gabe, very much as well. You, the listener, you're awesome. Thanks again. Again, like it, share it, subscribe, and we will see you very soon on the next episode. Thanks, everyone.
If you like this episode of Big Fat Real Estate Checks, then show some love by leaving a comment and a good rating. Also, as a thank you for tuning in today, we've got a special free gift. The journey to passive cash flow for a life starts by finding deals, and it's easier than you think. Simply go to getdealsbytuesday.com, enter your email address, and we'll send you a free quick start course called Deals by Tuesday. Even if it's 11 p.m. Monday night, this course will show you how to find discounted real estate deals by Tuesday. It's that fast and simple. Go to getdealsbytuesday.com and start your journey toward life-changing cash flow today. Thanks for tuning in, and we'll see you on the next episode.